Todd VanDenburg here with VanDenburg Capital Management and the Uncommon Sense Update. Greetings and thanks for watching. So last week we had a decent week in the markets. The Dow, the NASDAQ, and the S&P were all up. But nothing to get too excited about. It was a shortened week for the Thanksgiving holiday. Volumes were low. We did get some decent news regarding existing home sales. They were up. First-time jobless claims were down, and consumer sentiment has been rising. So, that positive news sort of explains the markets up last week. What I do want to talk about a little bit this week has to do with our debt and the Federal Reserve. So, Janet Yellen is on her way out as the Fed chairperson, and some statements that she's made, she's pretty happy with, the job that the Fed has done and Fed's monetary policy, and I'm not nearly as happy as she is. The Fed funds rate is near all-time lows, and that means that if something bad happens, if there's some sort of an economic issue, the Federal Reserve is not going to have a lot of ammunition, a lot of things that it can do. Typically it uses the interest rate, to try to either increase or decrease economic activity. But I think I have a sense of why that might be, why they might be happy with the low interest rates where they are today. And if you think about it, our national debt since 2000 has gone from about $6 trillion up to over $20 trillion, in the last 17 years. It's an amazing amount of debt. And the Federal Reserve is the one who gets to decide, what are the interest rates that we're going to refinance that debt at. And I did have somebody, comment to me about how concerned they were that the interest on the debt is going to bankrupt us. And there's an interesting little piece of data that if you look at this, what you'll see is since 2000, in 2000 we were paying about $227 billion a year on our debt in interest. And that, again, that's with the debt at about $6 trillion. Today, we pay about $265 billion, so maybe 10%, a little more than 10% more, but our debt has tripled. And so that's one of the reasons we think the Federal Reserve is continuing to keep interest rates low, because the debt that we acquired 30 years ago, we were paying 9%-ish on that on 30-year treasuries 30 years ago. So as the Fed goes to refinance that debt, they're now able to refinance that debt at under 3%. So what that means is that we're able to accumulate a lot more debt, but the interest payment hasn't really gone up that much. So we think we understand why they're doing what they're doing, but it doesn't mean that it's not a potential issue. We're going to be watching it pretty closely here in the coming years. It's not anything urgent that needs to be, worried about right now. As a matter of fact, as we retire this debt from 30 years ago, if we can refinance it all at under 3%, I think that would be an amazing thing. But we do need to do something about our current government spending and the fact that we're running, deficits in the $600-800 billion range every year, adding it to our debt. It's something we're going to be watching pretty closely. Again, not a major issue right now, but it is important, that people understand that there are some potential bumps in the road ahead, and we're watching for them, pretty closely. So that was your update. I hope you enjoyed it. If you did, give us a like or give us a share, and we'll be back next week with another weekly update. Thanks for watching.